Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese. Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist. Taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors. We've officially made it to the middle of the year. Everyone, welcome to Facts versus Feelings, episode 143. Ryan and Sonu here. Sonu, this one is titled, exciting, Midyear Market Outlook 2025. First things first, show your fingers on the YouTube channel, Sonu. Did we survive?
Right. Yes,
we made, yeah.
Yes.
July 4th. All 10. We made it. You know, there was a house, from where I live, I'm going to say 4 away, that like at 12:30 at night on the night of July 4th actually had their garage burned down. So I don't know I don't know if it was fireworks related, but that's a big coincidence if nothing else. How was your holiday?
It was great. It was tiring. I was sick before the holiday, so I was hoping I would make it in time to get to the beach on July 4th morning. That happened, and it just got so hot. And I've got a bit of a tan, if you don't notice. But,
yeah, it's hard to tell. I was talking about you with some buddies. I said, he's my brother from another mother, my Indian buddy. I said, but he hates the heat. He's an Indian guy that hates the heat. I didn't know if he could even do that. Heat. But I know, so it doesn't make any sense. I didn't know that was legal. But
I am happy to be in cold Chicago. Well, it's been hot, and thank goodness for air conditioning. By the way, I should say our hearts go out to the folks in Texas. Yep. It's such a terrible tragedy over there. Hopefully, you can find just still missing folks.
Mm-hmm. No, absolutely. Yeah, this Mother Nature. It's terrible. And we're thinking of, I love Texas. I absolutely love going to visit Texas, and that part of our country is amazing. Great people. So definitely thoughts go out to everyone that's impacted by this terrible, terrible tragedy. So no easy way to go forward, but we're going to here. So let's see here. Let's just get into it. We can talk forever on this stuff, and normally we do. What were your biggest surprise or surprises the first half of 2025, Sonu? Then we're going to talk more about how we see the rest of this year playing out.
I have 2 surprises. One is Liberation Day was a surprise. How could it not be? Here he is, the president of the United States, holding up a big board showing tariffs of 55%, 75%, 85%, 145%. And then the other surprise is how quickly it came away. And how quickly it went back on pause, right? So, and we're still on pause. And I don't know, maybe there are a whole bunch of letters going out. This was as of yesterday, July 7th. Tomorrow.
You were reading them all, weren't you? I knew you were reading. They're all over Twitter. You were reading them.
I read 2, and then it was the same thing. So he's sending form letters to everybody.
Sonu's sending us notes on the team. He's like, look at this. These are the same letters. He's just changing a few words.
But anyway, who knows what's happening in the tariffs? But that was my biggest surprise. So I don't think anyone expected, the worst case tariffs are okay, maybe 20% tariffs on average. This is way beyond that. Yeah. But then it was almost as surprising as to how quickly, they backed off from those tariffs. So anyway, that's my big surprise. I have a market thing, but we can talk about that later.
Yeah, so I think I'll take a little different route. My biggest surprise is how surprised everyone was by volatility. Now, what I mean by this is we've talked on this very Facts versus Feelings podcast 6 months ago. We did our outlook. We expected stocks to do pretty well, but we were on record. There could be a 12 to 15% peak to trough correction. The first quarter the last 20 years has been really weak. The first quarter of a post-election year is extremely weak historically. And a first quarter after a 20% gains, not all that great. So to have some early weakness this year was not a surprise. And the other thing, I wouldn't call it a surprise, is how markets work, but a lot of those bears that were mocking you and I in 2023 and most of 2024, it felt like, all of a sudden turned in the bulls. And I'm looking around with our team, and even on this podcast, I'm saying, listen, if there's one thing that worries me, it's this guy is now acting like he was bullish the last 2 years. I know he wasn't bullish. He's yelling at me back in 2023. And sure enough, you had to shake that tree a little bit to kind of, get rid of those Johnny-come-lately bulls. And that's what happened. But I'm with you. Liberation Day, 10%, I think it's 10.5% drop in 2 days. One of the worst 2-day drops you've ever seen. We had one of the worst 2-month returns we've ever seen. And then you fast forward, and now we're looking at one of the best 2-month returns ever. And this Thursday is officially 63 trading days off the April 8th low. Why does that matter? Because there's 21 trading days in a month, so it's officially 3 months off the April lows. We're looking at potentially about a 25% gain in 3 months. That's only happened 5 other times since World War II. And it's usually pretty bullish going forward. Anything else to surprise you, or do you want to move forward here?
Yeah, I'm just trying to think back to Liberation Day and whether it's always going to be like, what were you doing on Liberation Day? I was actually flying back from Texas. I was on a plane.
Oh, wow.
I missed my flight the previous night. I mean, because of weather and things like that. I was flying from Dallas to Chicago. So I caught a 5:30 a.m. flight because I wanted to get home. And middle of the flight, I'm connected to the internet. I'm trying to catch some sleep. I'm trying to check in as to what's happening in markets. And then the news drops, right? I'm like, what is even happening? I can't even believe it, right? So I'm writing my notes on my notes app on the phone, and that turns into a blog. But yeah, the wild times. But I'll say this, one big surprise, I think markets have recovered, obviously, as you said.
Sure.
Even bond yields, the bond market sort of recovered. It's more or less where it was back in March and February and things like that. The dollar's gone down. We just saw the biggest first half drop for the dollar since 1986, 11% drop. I think that's where, I think ultimately that's, the big surprise for me, how much the dollar is falling. I'm not surprised that the dollar pulled back, but the degree of the pullback has been surprising.
Yeah, no, well said. On this very podcast in late January, I remember openly saying the dollar can make it a major peak. Everybody's bullish a dollar. Everyone's thinking alike, somebody isn't thinking, and that sure played out. But we're going to get into some more of those concepts. So right now, we're going to start talking about our mid-year market outlook 2025. Uncharted waters is what we're calling it. So, David, we can put up on the screen right now on the YouTube channel, I should say, our view for stocks this year and our view for bonds this year. Sonu, we came into this year expecting the S&P to gain 12 to 15% total return. We never cut that. We are still in a 12 to 15% range. As well, okay, is it all that high from here? I mean, there's still a decent amount, but I think the key thing I'm really going to hammer home, we never lowered our target. Were we close to doing it? I mean, maybe we were. Maybe we're glad
we didn't get time.
We didn't get time. But I mean, listen, if you listen to this podcast every week, which a lot of people do, we still said, there could be a chance stocks can come back. I've used the example of a slingshot many times. There have been 4 years where you're down 15% year to date, but you came back to positive. And every time stocks were up at least double digits. We were talking about the idea that could happen this year with some good news. And then bonds, 4 to 7% total returns, what we're expecting by the end of this year as well. So all in all, should be a pretty good year. Nothing to see here. Anything you want to add to our targets before we really dive into things?
No, we haven't changed. I mean, if you think about where the S&P 500 ended up at the end of June, it was up about 5.5%, and then proceeded on to make a couple of more new highs into the first week of July 1st, July 2nd. So that was positive too. The S&P 500 is up 6.5%. But I know we're going to talk about this, but really quick, that's a story about profitability too. Profit expectations haven't really taken a dive despite everything that's happened. And that's attributed, 50% of the market's returns this year. That's a good thing. That continues the story we've seen in, 2023, 2024 as well.
Well, absolutely. I look at the clock. We've got about 30 minutes. So let's just dive into things. First things first, we'll talk about the economy. We came into this year not expecting a recession. Slowdown, maybe parts of it potentially. People listen to this podcast, in 2023, 2024, we were saying the same thing. There wouldn't be a recession. Why, Sonu, do you still not potentially see a recession the remainder of 2025 here?
Short answer, the data hasn't turned yet.
Okay.
Right. And if you think about, what is a recession, first of all? Right. When you talk about recession, why are we worried about recession? Well, because as we just talked about, profits are ultimately what matters for, stocks. Where do profits come from? Profits come from the economy. Right. And that's why, if we have a recession, that means revenues are going to get hit. Profits are going to get hit. And even after Liberation Day, remember, so many analysts, I think macroeconomists, were saying by summer, which is right now, we will be in a recession.
Right.
Right. So many of them. I remember that. And it's like, okay, we could be. I'm not saying this is back in April. I was like, maybe we could, but let's just wait for a little bit, right? Before saying, oh, yes, we're going to have a recession. right? Or the probability of a recession is 90% or whatever it is. So I was like, okay, let's at least give it a month, if not 2 months before. And of course, then all the tariffs are paused and things like that, right? Which is not to say, coming into the beginning of the year, we thought maybe there's a 10-15% chance of a recession, which is always the case. There's always a 10-15% chance of a recession. Maybe after the whole tariff is, maybe now it's 20-25%. So slightly higher odds. But yeah, if you think about what is a recession, who calls a recession, right? It's actually the National Bureau of Economic Research here in the US, unlike in the rest of the world. And we actually have something called the Recession Dating Committee, right? Which is interesting. And they look at
that is not the dating committee I think anyone wants to be on. I don't know.
How do you get yourself on that?
I don't know. Do you blind date on that, or how does that work? I don't know.
So it's a bunch of economists at the National Bureau of Economic Research.
It sounds miserable.
I know. and they don't even get to it immediately, right? So one heuristic for a recession is like, we get 2 quarters of negative GDP growth. That's what they call a technical definition. There's nothing, that's not a real definition. It's a simple heuristic. But the reality is we did get 1 quarter of negative GDP growth, but that was because of weird things that were happening with net exports, which is exports minus imports and inventories, things like that. Yeah. But the NBER, as a reason, they don't look at GDP because GDP is really lagged. Instead, they look at 6 other indicators. And David, we can pull this chart up. The key economic indicators that the NBER looks at to say, are we in a recession or not, right? You got employment from both the establishment survey, like non-farm payrolls, and even from the household survey, which is where the unemployment rate comes from. And then you got industrial production, personal consumption, real personal income, and retail sales, wholesale trade, things like that, right? Not a single one now is pointing to a recession. Right? Not a single one. And there are, which is not to say the hard data hasn't softened. The soft data, goodness, Ryan? It's been 3 years. The soft data has been weak.
It feels like forever, but yes, at least since 2022 when all the soft data turned weak. Yeah,
exactly. Yeah. Sentiment has been awful, and there's been pieces of hard data like continuing claims, things like that have been weak. And here's the problem, right? Every time you get a new indicator, the entire, commentariat or, Twitter, let's call it that, jumps out and like, it's terrible. We are in a recession. And then the next indicator, the PMI comes out. That's bad. Like, we're in a recession. Then something else. It's just one after the other. So what we do, instead of getting waylaid by all these random indicators, and some of them are not random, it's like, let's put it all together. We have our own proprietary leading economic index. Yep. And David, we can pull a chart of this. And we do this for 30 different countries, right? It's tailored to how the economies of all these countries work. In the US, it's mostly consumption. So we actually have consumption-related stuff in there, things like auto sales, retail sales, income, consumption, credit, housing, all of it, right? Right now, short story, it does not point to a recession. Yeah. Right? That's it.
And long story, it didn't point to a recession a couple of years ago either. Right? How long have you been creating this proprietary indicator? I mean, like
12 years.
I thought it was a decade plus. So you've created it. We can't totally give away how the sausage is made. Honestly, I don't know how the sausage is made. I work here. I don't want to know. It's one of those things like, keep me away, keep me away. But no, it absolutely has accurately said that our economy is not going to go into recession, and it still is. Now, let's do a quick, Cliff Notes crash course of Thursday's jobs number, right? We're talking big picture, what we wrote in our outlook, but I do want to talk about that. Jobs came in better than expected, 147,000, ballpark 110,000. The unemployment rate dropped a little bit, expected to increase. The participation rate of prime age workers, I believe it's 25 to 54, that ticked higher. I mean, we probably find some flaws in it, but the market liked it. What did you think about the recent jobs number? Again, some real-time data for the listeners.
Big picture is the labor market is doing okay.
Yep.
Right. There are a few cracks, and especially once you look under the hood, like 70% of the jobs created year to date, about slightly under 800,000 jobs. 70% of that has come from non-cyclical areas, which is healthcare, social assistance, and education, state and local government, things like that. Right. So the cyclical economy is not firing, but we knew that because rates are elevated. We can talk about the Fed's role here as well, right? The tariffs and things like that. But so the job market, on the face of it, you have to look at the unemployment rate, 4.1%, say, that's not bad, period. That's it. But at the same time, the other side of this is that job creation has slowed. And when job creation, fewer number of jobs are being created every month. Now, because net immigration has eased, we don't need to create as many jobs to keep the unemployment rate from going up, right? Because, there are fewer people looking for jobs in the economy. So the economy, even with creating 150,000 jobs a month on average, that's pretty good. Whereas a year and a half ago, we had to create 250,000 jobs to keep the unemployment rate from going up because we had a lot of immigration at that time. So that's a difference. But the other side, as I was coming to say, is that you have slower job growth. You have slower wage growth. Wage growth is easing. Right. Wage growth is growing about 3%. By the way, that's not bad. That's what we had before the pandemic as well.
Sure.
Right. We can talk about rates because that's important here.
We had a higher rates from the Fed now than we did then, even though wages are about 3%. Yeah,
exactly. But wages have eased to 3%. Job growth is slowing. Hours worked is soft. You combine all of that. What do you get? You get aggregate income growth in the economy. How fast is our incomes growing across all workers in the economy? Over the last 3 months, that's slowed to a 3% annualized pace. What does that mean, right? Think of that as your nominal GDP growth. Nominal GDP growth over the last few years has been clocking in around 5%, 6%, which is why the US economy grew faster than China in 2023 and 2024. Nominal GDP terms, right? Now, if that slowed to 3%, that's a big slowdown. I mean, this is not recessionary by any means. It just tells us real GDP growth is probably clocking in 1% to 2%, going back to our own proprietary leading economic index. That's the story it's telling us. The economy is doing okay, but it's growing below trend, right? That's not recessionary either. That should be enough to support corporate profits too.
No, well said there. And again, what was being priced in this time 3 months ago was a recession. So maybe a little slower trend growth is actually better than what was being expected this time a couple months ago. I know you sent a couple different charts. Any other charts or concepts you want to talk about economy before we move forward to policy?
No, I think this is good. I mean, it's mostly the LEI. Actually, let's put up one chart which can tell. I mean, it just shows our LEI, what it would have done in prior bear markets and prior recessions. So we're looking at the 1991 recession, the 2001 recession, 2007, 2009 recession, and 2020. And we see, and David, we can put this chart up as well. We see our proprietary leading economic index start to collapse, well ahead of the recession. Right. And remember, we don't know when the recession is because by the time the NBER chooses to tell us when the recession is, it's a whole year later.
Stocks are hitting all-time highs.
Right.
I mean, you missed it.
Only like 6 months ago. But what we see is, we want to know in real time what's happening. And this was my way of creating that famous Sembolis chart, which shows the stock market with GDP growth and earnings growth and saying a GDP and earnings growth does not predict what the stock market is going to do. And that's true because they're very lagged variables, right? By the time you get GDP growth, it's the end of the quarter, then it gets revised and all of it. Earnings is also lagged because it's the previous quarter's earnings. We're already in Q3 and the second quarter's earnings season hasn't even started. By the time you get the full picture of second quarter earnings, it'll be middle of August, right? If not end of August. But at the same time, we're getting real-time economic data. You just talked about jobs number. We know what the jobs pay situation looked like in June. And that's part of what goes into our own leading economic index. And that's what we keep track of to tell us, are we in a recession? Right now, the answer is no, but the economy is growing below trend. That's okay. That's still supportive of, like I said, profit growth.
Okay, no, well said. Do you want to go ahead to policy now?
Let's do that. Yeah.
Okay, so this week, again, more real time. We just saw the passing of the one big, beautiful bill. We're hearing how it's going to add, huge deficits and trillions of dollars. And, it's a bunch of spending the first several years. And you get some of the benefits and the savings in the future. People aren't crazy about that. What's your take on policy from that point of view, from the big, beautiful bill, Sonu?
And what's amazing is that the federal government's running 6.5% deficits. 6.5% of GDP, I should say, right? Deficits. And by itself, that should be supportive of two things. One, the economy, obviously, because what does that mean? The government's continuing to pump money into the economy. That's essentially what we're talking about. And that essentially ends up as corporate profits in a lot of cases, right? And that's why deficit spending is good for, at least over the short term, it's good for corporate profits. And with this bill, I think we see deficit spending go from 6.5% to maybe 7.5% of GDP. That's crazy.
Okay.
That's really high. It's nothing like we've ever seen before during an economic expansion. Usually during an economic expansion, we see the opposite. We see the deficit eventually reducing and getting into a surplus, the budget balance, right? That's not the case now. It didn't happen. But, we kind of played this movie out in 2017, 2018, 2019. We passed a big tax bill, deficits rose. That was good for corporate profits. The markets were doing well. Of course, we had COVID and all of that. But I think similar story right now. I mean, as long as deficits kind of move higher, that's going to be supportive of corporate profits in aggregate. I'm not telling you, saying, this sector over that sector will be helped or anything like that. That's a whole other set of analysis.
Right.
But aggregate profits should be supported by fiscal deficits. Now, the wrinkle here is tariffs, right? What did tariffs do? We don't know where tariffs will shake out. Who knows? Literally every day it's changing. I don't know how many letters have gone out during this time that we've spoken so far. But we don't know what the tariff situation is. But what are tariffs? Tariffs are a tax. It's pulling money away from the private sector into the government, right? So that's going to offset some of the, stimulative impact of the tax bill, but not too much. I still expect deficits to go up. I still expect that to be at the margin supportive of corporate profits.
Well said there. And again, you talked about that concept, maybe a week or two ago on this very podcast, where Israel's got one of the strongest stock markets we've seen in the world the last several years, up over 70% since October of 2023, when the war started. And to be honest, they've increased their deficits a lot, and it hasn't really hurt them. The U.S., what really ended the tech bubble bursting in the early 2000s? Well, it was the war in Iraq. Go back and look at your history books. March 2003 is when that war ended. What happened? What changed? What you just said. We started spending a lot more money, started running a lot larger deficits in 2003, 4, 5. And as a result, stock market sniffed that out and did bottom. Let's see. So that's the big, beautiful bill. You want to talk about the other F word, the Fed?
The Fed. We talk about the fiscal side, the Fed. Yeah. Look, the other side of big deficits is, where's the pain? There's no free lunch here. Exactly. Well, and we are seeing there is no free lunch because interest rates are high.
Right. Fed's in a tough spot, is the way to put it.
Well said. Yeah, the Fed's in a tough spot. And they've been waiting. I mean, when we started the year, we thought, okay, maybe there'd be 2 rate cuts. We said that will be supportive of markets. Yep. But then we got the tariffs. And here we are 6 months later, into a 7th month of this year, no sign of rate cuts.
Right.
July is off the table because obviously with the unemployment rate coming in at 4.1%, they're like, okay, the labor market's not breaking, so we don't need to rescue the economy and cut rates in July. So the earliest will be September. But I don't know, if we haven't seen tariff inflation yet, right? And that's not to say it will show up or it won't show up. Part of the reason, I was talking to a friend of mine who is the head of procurement at one of the largest, his company is one of the 15 largest importers in the United States. They import a lot of, medical technology, supplies, things like that for hospitals. And they said, he was telling me, we're going to pass all the tariff costs, but they have a lot of inventory right now that they purchased before the tariffs went into place. Yep. So they haven't passed the costs yet. Starting August 1st, he said, we're going to start pushing all the prices.
Oh, August 1st. Interesting.
August 1st. So think about that. August 1st, let's say, that's just one company, right? And it's totally anecdotal. But by the time that shows an official inflation data, it's going to be like September, October, November, right? You and I know all the crazy stuff that happens with official inflation data and all the lags and things like that. But that's what the Fed is waiting for. The Fed's hearing the same story from local businesses. You hear the various Fed governors, Fed chairs talk to local businesses, and they're telling the same thing. They're going to, and as far as possible, we're going to try and push the prices to consumers. They haven't done it yet, but I think it's early days yet. And that's been the biggest impact of the tariffs, right? For me, it's not like, yes, the tariffs went up to 145% for China, came back down to, 55% now. Who knows where it'll end up? Who knows? But it's the uncertainty of it and it's the downstream impact of keeping the Fed on pause for longer. And because of that, interest rates are elevated. We know housing is suffering as a result, and even investment at the margin.
That's true. We didn't really talk about housing for the economy point of view. We can just circle this together. Clearly, the housing market is a very, very weak part of the overall U.S. economy right now due to simply higher interest rates. Right. Now, again, we're on record, start of this year, the Fed probably should have been cutting Maybe they still should be cutting right now, but we're not in charge of the Fed, right? The Fed, I mean, Jerome Powell himself 2 weeks ago in front of, I guess he was in front of Congress, right? He gets grilled a couple times a year, said, hey, if I let the cat out of the bag, I would have cut twice if we didn't have tariffs. He said that. You kind of knew, you kind of knew that was there, but he finally said it. So let's just be blunt or be upfront. Will the Fed cut the second half of this year then? I know you're what do you think? I mean, the market says 2 cuts, but what do you think?
I feel like over the last 2 years, one thing we've always gotten right, even going back to late 2022, and this is shown in the portfolios, is our calls on the Fed. Yeah. Right. And right now, I'm like, I don't know. I honestly, I'm like, I could easily make a case for no cuts this year, but that's partly based on the fact that I don't see a recession.
Right.
Right. If I thought that the economy is really slowing down, if the unemployment rate was going to go up from 4.1 to 4.5, 4.6%, I would say, yes, we get a rate cut. But if the unemployment rate stays at 4.1, 4.2, even 4.3%, I don't know that we get rate cuts this year. So I'm going to say maybe we get 1 cut by the end of the year, by December.
Well, let's see. I know you do have that chart about what is this? Monetary policy is tightening.
Oh yeah, right.
Despite the Fed. So let's put that one up, David, and talk to us about this chart on the YouTube channel.
Actually, this is good. You brought it up when I talked about wage growth, right? Yes, exactly. Wage growth has eased to 3%. That's similar to what we saw before the pandemic. So by itself, that pace of wage growth is not inflationary. That shouldn't be worrying. The problem is, where are policy interest rates? Back in 2019, policy interest rates, the Fed policy rate, was at 1.5% to 2%. And wage growth is at 3%. Whereas right now, wage growth is close to 3%, but policy rates are closer to 4.5%.
Right.
Policy, big picture, policy is really tight. Right? That's because their inflation numbers are obviously on the higher side. Core PCE, core personal consumption expenditures index, which is the Fed's preferred index, inflation metric, that's running at 2.7% year over year, right? So, but there's no reason to keep, maybe based on just that core PCE data point, rates should be, let's say, 3.5 to 3.75% policy rates, but it's closer to 4.5 right now, and that's because of the tariffs. Yep. Right. And the Fed is sort of forecasting inflation to be higher because of the tariffs. But that's, ultimately, if you think about, we just talked about housing. Housing is where the pain is, literally. Yep. Housing affordability is crashed. If you think about, if you're going to go pick a mortgage right now, it's like, my salary is increasing about 3% a year, which is not great. For, a few years back, if I changed my job, I could have gotten a 10% raise, or people are giving me 5% raises year after year. But now it's slowed to 3%, which may be even 2.5% in a lot of cases. But I'm paying 7% for a mortgage. That's where elevated rates, tight policy makes an impact. And, we are seeing I think, and at the margin, we talk about deficits. At the margin, deficits are going to keep interest rates higher for longer.
No, very interesting stuff there. I mean, so the reality is the economy's still growing, maybe a little slower than trend the second half of this year. We still don't see a recession. Fed's in a tough spot. Maybe they cut, maybe they don't. I mean, there's some good arguments on each side there. But again, if we get some maybe better news on tariffs and the inflation data, you and I spoke a couple of weeks ago, big reason inflation has been stubborn. We've talked about this for 3 years now, is shelter. Shelter's high. It's a big part of inflation. We'll keep that real high level and simple. Last 2 months, we've started to see some cracks that rent prices and shelter is finally coming back. We knew it was lagging. So maybe different parts of inflation go up because of tariff, but you have this other part's going down. So listen, we talk. That's why we do this podcast every week. We'll keep talking about it. I think I'm looking at the clock. We're trying to get forward. Anything else on the policy economy point of view, or do we kind of?
No, let's talk about stocks. So let's
go there. So we came into this year with the S&P 500 to gain between 12 to 15% total return, and we're leaving that there. We never changed that. Even when the S&P was down 15% for the year in a near bear market on April 8th, we said, we still just don't see reasons to think it's that bad. Fortunately, we've come back. Now, we can share on the YouTube channel now another 19% bear market. We're sharing. We've seen this before. We have seen this before. We've had multiple near bear markets going back to the last 50 years. And everyone gets all bared up. You don't have to have. You can have a bear market without a recession. 1987, 34% bear market. didn't have a recession. There's some other examples. I mean, 2011 was a near bear market. 2018 was a near bear market. We didn't have recessions then. You could argue there's earnings recessions, manufacturing recessions in some of those times. Even early 2016, we're in a manufacturing recession back then, a slowdown, but no recession. And stocks pulled back pretty good. But again, just a reality. And with Sharon, let me just look at it because I don't remember exactly. Off those lows, off those near bear markets, a year later, you're up almost 30% and higher 100% of the time. I don't know if we're going to be up 30%, but you know what? We're up like 20. Well, we're up like 25% off the lows as we speak right now. And that's just 3 months later. So, maybe I will take it. Maybe that could absolutely be there. The other concept I want to point out, Sonu, that I'll bring you in. David, let's share this one. Bull markets last longer than you think. We've talked about this. This bull market, we'll put it this way. It'll be 3 this October, right? So it's not that far away being 3. The average bull market, going back to how far we go back on this chart? Okay, it's World War II. Back to World War II is about 5 years. All right. So, and then I've mentioned before, bull markets that get to this point of life into their third calendar year, the last 50 years, they've lasted 8 years on average. So again, it's like a cruise ship. Once these get moving, they can keep moving. Now, trust me, we shared these concepts 6 months ago. And on April 7th, April 8th, I was like, oh boy, we're about to have a bull market, so you can throw that out the window. But we had the near bear market, and now we're kind of, I hate to say off to the races, but it sure feels that way. So anything you want to add on bull market lengths or anything I just talked about, and I'll chime in some more on markets.
It takes a lot to break a bull market. Is my takeaway from what you've shown. It takes a lot to break. I mean, yes, a recession is one way to do it. Right. But we talked about why we're not expecting a recession right now, especially with deficits, finance, taxables and things like that.
Yeah.
And hopefully a Fed rate cut. Right. They're going to be behind the curve and by the time they cut, but still, hopefully we get that. But it takes a lot to break a bull market. It was not for lack of trying because,
well, Liberation Day tried. Gave the old college try there. Yeah.
And I'm laughing because I just saw a Bloomberg alert on my phone saying Donald Trump said the August 1st tariff deadline won't be extended. By the way, when did the tariff deadline move from July 9th to August 1st? Well, I guess sometime in the last 2 days it did.
Yeah, you had to pay attention. I don't know.
Yeah. But, what's the... over under on that deadline being pushed out too, right? So, but so all this to say, part of it is also if you think about household balance sheets. You and I have talked about this in the past. They're in very good shape. Part of the reason is home prices have gone up. That's not great for people who are looking to buy a home, but it's great for homeowners. And the other side is stock prices have gone up. Yeah. Over the last 5.5 years, the S&P 500 is up 112%. By the way, most of that has come from profit growth. Less than a quarter of it is because of multiple expansion. So this is not a bubble, right? I should note this bull market that we are in, it's come on the back of profit growth, right? So that's a big thing. But it's almost like policymakers cannot afford to send the market into a bear market because, that's going to hit household balance sheets. And we know politicians want to get reelected. So I think that there's a reason why we get a near bear market and then suddenly it's like, we're reversing course. So we'll see.
Yeah, no, you're probably right. I mean, there probably is something there. We've seen, we had a near bear market, for those that remember this, in December of 2018, right? The Fed, argue made a policy mistake. It is what it is. But the Fed didn't cut. Market wanted to cut. Market threw a big fit. And then sure enough, by that first week or so of 2019, the Fed said, oh, okay, never mind. We're going to become dovish now. And then the market was off to the races. Okay, so here's some more real-time stuff for all the listeners out there. We didn't necessarily put this in our Outlook, but I think this is really important stuff. Where did I put it? Here it is. Make sure I can read this correctly. Let's see here. Okay, here we go. Got it. I'm calling this the sweet spot. And I did write a blog on this, actually, carsongroup.com/research. Oh, by the way, by the time, let's see, this comes out on Wednesday. So on Thursday, when our Outlook is out, sometime hopefully that morning, you can go to carsongroup.com/Outlook. And that'll be everything we're talking about, all the different collateral. We're doing YouTube videos. We got this podcast. We got the white paper. We got some others. We've got a PowerPoint presentation. That's just for our partners. That's some stuff just for our Carson partners. But a lot of it is out there. So please be sure to check all of that out at carsongroup.com/Outlook. But I'm calling this a sweet spot, Sonu, because at the middle of the year, S&P's up ballpark 5.5%. Your average year, going back to 1950, the first half is about 4.2%. So, hey, it's a little bit better than average. But some of the worst second halves ever have taken place when? after some of the worst first half. So like 2008, bad first half, terrible second half. Seen examples like that. Now there's a time like 87, we were up a ton the first half of the year, but then you pulled back. So I'm calling this kind of like porridge, right? We're up between 5 and 10%. I found, I believe it was 16 examples. Let me see here. 15, sorry. 15 examples when the S&P is up between 5 and 10% the first half. So solid, but not runaway,
Not too hot, not too cold.
Not too hot, not too cold. The rest of the year, higher, 13 out of 15 times with above average returns, not by a ton, but a little bit above average returns, but again, consistently higher. The other one I want everyone to know, and I might have mentioned this last time, but I'm going to mention it again because these are good when you put them next to each other. May and June usually aren't that strong historically. On this podcast, we explained why we thought they'd be strong this year, but usually they're not that strong. When both of those usually weak months are higher, the rest of the year is higher. Ready for this? 15 out of 16 times with some huge returns. So when you stack those two studies, it kind of tell a similar story on top of each other with a lot of the things on the economy and the inflation front and all different things. It continues to suggest to us that this is a bull market. Stocks are going to do well, and we're going to get a little more into it. But I think the U.S. plays catch up in a big way. I think the U.S., which didn't do as well the first half of the year, what are we up? 6-7%. Germany's up well over 20. I don't think we're going to catch Germany, but I think we're probably going to gain a little more than Germany. It doesn't mean we don't like Developed International. We'll talk about how to do a portfolio the rest of this year in a little bit. I think the U.S. does well. And the reason, Sonu, I'm going to bring you in now, David, the final chart that I shared was earnings, right? We've kind of hinted at some of this stuff, but earnings continue to drive long-term stock gains. People are so confused. Everything's terrible. Everything's horrible. They told me on TV this was going to happen, told me on TV that was going to happen 3-4 months ago. Yet stocks are at all-time highs. How is it possible? Because earnings continue to be strong. So we are sharing on the YouTube channel the forward 12-month S&P 500 earnings outlook. What's it look like, Sonu?
It looks good. The line's going up and to the right, which means stock prices should go up and to the right. Look, ultimately, the market cares about profits, right? A profit's going to go up or down. I mean, there's, optimism that swings wildly up and down around that, sometimes into pessimism after things like Liberation Day. We've seen that. But if you think about, next 12-month earnings for the S&P 500 right now, it's about $281 a share, something like that.
Yeah.
But that's actually, next 12 months, half of it is 2025 expected earnings and half of it is 2026 expected earnings. As we move forward in the year, as long as the 2026 earnings expectation for the S&P 500. Right now, that's at about $298, $299 per share for the S&P 500. As long as that's not moving lower, we should see expectations for the next 12 months, earnings expectations for the next 12 months continue to move up, right? And what I've been looking at over the last 3 months is forget 2025 earnings. I know that's what a lot of people are talking about. Our 2026 earnings going down by a lot. And it's come down 3% since the beginning of the year. But 2025 earnings have also come down about 3%, which means what? The growth rate, the expected growth rate of profits in 2026 haven't really moved. Markets are still expecting, Ryan, after all this, after everything that's happened, markets are expecting about 13.5% growth rate for profits in 2026. Yeah. As long as that story doesn't go away, I think all of the stuff you've been talking about continues. Yeah. So we've got profit growth, we've got momentum, and we don't see a recession yet.
The other one, the kind of the cousin to you, if you will, to earnings is our profit margins. Literally, profit margins just last week hit a new high this cycle. I mean, I'll tell you, that's a little surprising because everyone told us profit margins had one way to go and that was down. So again, that's a little more cushion, if you will, for companies to kind of maybe eat some of the potential costs from tariffs if they choose to or not. But profit margins moving higher and earnings and profits going higher are dual tailwinds, if you will, to this bull market and positives overall. I don't think I had too much more on stocks. Looking at the time, we probably need to wrap things up soon. Anything else on equities? We'll talk a portfolio in a second.
Other than, to dovetail into a portfolio discussion, I mean, we, even before Liberation Day, we were diversifying even our equity part. We're still overweight equity. So, our portfolio has really, under the hood, it's really shifted from what it looked like 7 months ago.
Very true.
Right? Despite, we're still bullish. We still are overweight stocks over bonds by quite a lot, I should say. But the underlying, portfolio composition has changed. Even within equities, last 2 years, we've pedaled to the metal. right? Overweight equities, and especially overweight US equities. We came into this year where, like, you talked about the third year of the bull market being more volatile, slightly lower returns, things like that. And based on what we were seeing policy-wise, policy uncertainty, all that, like, maybe it's time to temper things a little bit and diversify into, international stocks, especially developed international stocks. And then we got news out of Europe saying they're going to boost fiscal spending, things like that. And I mean, President Trump was just in Europe the other day, last week or 2 weeks ago, and NATO countries are planning to boost defense spending. Again, we're talking about fiscal deficits there, right? That should boost profits abroad as well. And that's why we move back to a neutral position, US versus international. We're not betting that international will do better or worse, or EM will do better, anything like that. We're still underweight emerging markets, but we're just taking the position that we don't know which will do better. We like stocks, we overweight stocks, but we're neutral, US versus international.
Yeah, no, exactly. We had Barry Gilbert on this very podcast last week, and we talked about a lot of these concepts on our team. We manage close to $5 billion for our Carson partners. And when we talk on this podcast, we're talking about what we're really doing with real money. And no, we're not always right, but we've had a pretty good run lately. And on March 3rd, we actually did some of these changes we just talked about, where we went into some more developed international, because you were talking about, look what Germany's doing, look what's going on around the globe. And then Liberation Day happened and things. And we're like, okay, well, that worked out pretty well. So again, Grant on our team, Grant Engelbart says, when in doubt, diversify it out. There's nothing wrong with being diversified. And this year is a huge reminder, with most of Europe up over double digits, some countries like Germany up over 20%. This is why we preach to stay diversified, especially when things are a little more uncertain, like they clearly have been so far this year. So let's talk about, we'll wrap it up now with bonds. We always leave this last because we have been underweight bonds. Maybe there's some opportunities. Need some of those Fed cuts to come, though. What do you see on the bond fixed income side of things the second half of this year, Sonu?
One thing is, through all of this, we haven't really seen corporate spreads for bonds or high yield spreads blow out.
Oh, yeah.
Right?
True.
They increased a little bit, but that's fine. That usually happens when the market goes down, especially when we have a near bear market. You would expect high yield spreads to, start increasing, but they didn't blow out. And right now they've come back down, which suggests that, the bond market doesn't expect, a recession, right? Where companies that borrow, especially companies that borrow on the high yield market, are going to default, anything like that. So, but the other side of it, there's not much opportunity there. Spreads are tight.
And we talked about rates being kind of high because the Fed's stuck. So that,
Exactly.
So just remember for listeners, yields down, bonds up, and vice versa.
Right.
So we don't get yields down, don't see 3 or 4 cuts from the Fed. Bonds might lag stocks again second half. That's probably what we're seeing.
So we're overweight stocks, we're underweight bonds, and even within bonds, we prefer treasuries to corporates because corporate spreads are, much tighter. There's not much opportunity there. I mean, that's a good thing from the economy perspective, but not great when you're looking for opportunities within the portfolio. Why do we have treasuries? Because if we are wrong, going back to we won't always be right. If we are wrong about a recession, especially if we have a deflationary recession, treasuries are likely to protect the portfolio.
Exactly.
Interest rates will come down. That's not what I think will happen, but you have to play the odds here.
Well, Liberation Day, I mean, bonds did well. Bonds acted like bonds in April. For a while, bonds did not act like bonds. They didn't zig when stocks zagged. So that right there helps you. I say, we all know stocks historically do better than bonds, but bonds help you sleep at night to help you stay in your stock so you don't panic and want to sell at the worst possible time, like a lot of people did on April 9th, April 8th.
Right. And then the other side, in terms of diversifying or diversifies, literally, we're not just betting on bonds because we could have inflation. Now, I don't think we'll get a lot of inflation, but again, we could be wrong about that.
Sure.
But if we are wrong, well, what do you need in the portfolio? You need things like commodities, managed futures, gold as well. If treasuries don't protect, maybe gold protects. And this is something you and I have been talking about for 2.5 years.
Exactly.
Or at least 27, 28 months or so, ever since that SVB crisis happened. And this gets back to what one thing I'm proud of is how we read the Fed, how we do Fed calls, things like that. At that time, we were like, we don't want any duration. We don't want any treasuries. We didn't see a recession after the SVB crisis. They say, but we want protection in the portfolio. Let's use gold. Now, gold's up, I don't know, Ryan, what, It's up a lot since then.
Up a lot. Yeah, well over 50%. Yeah, we added gold in early April 2023 in the money we run. So and I kind of pushed for that. I thought the dollar might go lower. And we looked at potential worries, and I just said I think gold's going to do better in bonds. Boy, if I ever got anything right in my life, I guess it was saying gold to do better in bonds starting in early 2023.
You'll never get an argument from me, but no.
I'm not saying always. What does Sonu mean in Indian one more time for the listeners? Gold. It means gold. Exactly. Yeah.
So, but this year, that's another surprise. Gold has been the best performing asset this year. Mm-hmm. Yeah. 25%. It's better than even, the second best performing asset class that amongst the major ones that we track is the MSCI EFA index, which tracks international developed markets. That's, not done as well as gold, but it's up 20%, something like that, right? 20% year to date. That's a story of the dollar weakening. Exactly. I started saying, what's the surprise this year? How weak the dollar. The fact that the dollar has been weak is not a huge surprise, because what happened when it came into the year? As you said, all our friends, quote unquote friends, were bullish. All the bears turned bullish, and everyone's like, "Oh, the U.S. is going to see 3% GDP growth."
Right, dollar's going to go up. Only one way to go up.
Yeah. So if you think about, the U.S. growing at 3% GDP growth, the rest of the world, everyone's like, "Oh, China's slowing. Europe's growing at 0%," things like that. And what happened 3 months, 6 months later? Well, the U.S. is now growing below trend. Let's say 1.5% to 2%. Okay. Expectations for growth abroad have increased. So in that scenario, the dollar should weaken. Foreign currencies should appreciate. That should be a tailwind for international equities. And I think that's essentially what we've seen. And gold has been a beneficiary too.
No, absolutely. That's why, again, you stay diversified and don't always chase the latest shiny object. And honestly, gold's the shiny object now. And part of me is looking at everyone now. Everyone's beating up the dollar, hating on the dollar. Maybe the dollar's going to start to bounce now. Maybe gold doesn't do as well. That's okay, because that's why we have an overweight to equities. It's just there in case things go poorly. All right, Sonu. So again, we're really proud of our mid-year outlook, which again you can access on carsongroup.com/outlook. This was episode 143 of Facts versus Feelings, again on our mid-year outlook. What's any bits of wisdom, like final wisdom for the second half of this year that investors can kind of take note as we head into, again, uncharted waters?
I think there's a lot of uncertainty, especially on the policy side. And maybe it all feeds in together. Tariff policy. I mean, who knows what's going to happen? What my next Bloomberg alert is going to tell me.
Oh, geez. Who knows? That's true. Who knows what that'll be? Yeah.
Right.
If Elon Musk has another black eye, I'm going to be worried. I'm going to be worried. Because when he came in the White House with that black eye, so everything started going a little wonky out there. Yeah.
Yes, no kidding. But that feeds into Fed policy uncertainty. We talked about that. But when things are uncertain, when in doubt, diversify it out. Diversification has been a bad word for the last decade.
Yes.
But right now, we talked about it last week with Barry as well, who manages the portfolios with us. When things are uncertain, it's time to maybe shorten our bets. You don't want to be concentrated in any single part of the portfolio, right? Any single part of the market. And that's essentially how we are thinking about things right now. We still like stocks, but we're diversified.
No, you really did a great job summing that up. I think I'll take a little different angle. Hopefully there's a lot of good listeners out. Well, a lot of listeners and a lot of financial advisors. Hopefully you have a good financial advisor who really helped you during these times, and if you need one or you're looking for one, we know some good ones. Yes. CarsonGroup.com. You can go and you can reach out, and we'd love to help connect you with some of the very best financial advisors, because a very unfortunate truth, people know what I do for a living. So in April, I had so many random people that I haven't heard from for years. And I mentioned on this podcast, this is bullish. I'm sorry, but so-and-so is telling me how bad everything's going to be. The lows are here and it's priced in. The honest truth, a lot of people made some very poor investment decisions in April, and unfortunately have cost themselves. And again, if you're in that group, it's okay. There is hope. We'd love to help you here at the Carson Group, get you with a financial advisor who will help you, and a lot of times help you from yourself, right? Our brains are wonderful things, but they also do terrible things. Back in caveman times, when a saber-tooth tiger's coming, you go in the cave and you hide and you do everything you can to survive. But people don't always make the right decision when they're under stress. We've seen that throughout history. AI is here, technology is here. What's not going to change are human emotions. And when people get scared, they make bad decisions. And we would love to help listeners out there. If you need a good financial advisor, we know something, so we can help there. With all of that, everyone, again, this was episode what did I say it was? 143, episode 143 of Facts versus Feelings with Ryan and Sonu. We appreciate all the listeners, had a lot of good downloads and listens. Hopefully you enjoy our mid-year outlook. Let us know. You can email us. What is it? Facts versus Feelings, Facts vs Feelings at carsongroup.com. Let us know what you think of the outlook or any other questions. With all that, we went a little long this week, but a lot of stuff to discuss. We appreciate all the listeners. Here's to another happy, healthy, and potentially wealthy second half of 2025. See you by next week. Thank you. Take care.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.